Hi, everyone. Thanks for joining me today. I really appreciate it, and I'll give everyone a few seconds to join here. But the way that I want to kind of structure today's live is I know that it's a busy fourth quarter for a lot of realtors out there. So I want to keep it nice, straight to the point, and we'll get through it as quick as we can. And yeah, it's going to be a great time. So if you have any questions, I'm not going to take any on the live, but be sure to comment it below, or there'll be an opportunity for you to book a call with me at the end where we can talk about your situation specifically. So with that, we'll get straight into it. So the reason why I want to talk about the business structure that can save you five figures or more is because first, it's really the biggest question that I get in almost every consultation I have, right? Every realtor is curious if they're structured in a way that they can save the most taxes and that makes the most sense. But to kind of double down on that, it's also the quickest area of opportunity to save a lot in taxes, right? So it's almost like a FISBO or an expired lead, right? Where you have just this opportunity sitting in front of you, ready to put money back in your pocket right away. And so that's why we're going to talk about this today and hopefully get some immediate savings back into your pocket. So the quick disclaimer, right? Every situation is unique. So be sure to consult with your CPA before applying this. But what I will say is that I've consulted with realtors who are just starting out, trying to be preemptive, all the way up to REMAX top 50 agents making over $1 million a year as an individual agent. And the fundamentals of these business structures are really the same through all those levels. So this is going to apply to 99% of you. But like I said, there are unique situations out there. Make sure you're consulting a tax specialist to make sure that you don't have one of those weird, unique situations in which it doesn't make sense. So with that, let's get started. And what I want to do is I want to work through the business structures kind of from the worst from a tax perspective all the way through into where I think you should be. And so hang in there with me. We're going to start the worst, end the best where you should be, and then how you can implement it in your business. So the first kind of structure, if we can call it that, right? It's not really a structure, and this is why it's the worst, is a W-2. So if you are a realtor or a real estate agent who is working on a set salary or a commission, but you're only getting paid by a W-2, that's kind of the worst place we can be. And the reason for that is because you don't get to take any write-offs against that income. So whatever commissions you make is the commissions you're going to pay taxes on, and there's not really much you can do in terms of tax planning. And so, yes, it's nice that you're on a W-2. Yes, it may be nice that you have a set salary, but in the realtor world where a lot of people are working on commissions, where I don't think I've ever met a realtor who hasn't spent a lot of money to close deals or, at least driven around and had the mileage to deduct, the W-2 is the worst place we can be because you don't even get a tax deduction or a tax write-off for any of those expenses. So just had to throw that one out there. The W-2, if you are on a W-2, right, maybe it makes sense if you're on a set salary, but really you want to try to transition away from that W-2 into a 1099. And the reason for that is so you can take deductions, right? It changes you from an employee to a business owner, and the IRS loves to incentivize business owners. So kind of our worst structure starting off, at least from a tax perspective, is a W-2. If you're on that, we really want to try and get shifted over to becoming a 1099 employee. So that's a perfect segue into this second structure that we're at, right? And so this is what's called a sole proprietor. And a sole proprietor is essentially someone who receives a 1099 to their own name. So they've made that transition from a W-2 to a 1099, but they don't have an LLC, they don't have a business. They are getting paid straight to their own personal name, and they are paying their taxes in their straight own personal name. And so some of the benefits of that, right, is that great. Now that I'm being paid on a 1099, I can take these write-offs. I don't have to pay taxes on the top line number. I get to take all these expenses and help lower the taxes in that way. So it's a step up from the W-2. But the part that really kind of sucks about this structure is the IRS kind of likes to punish small business owners who aren't intentional and haven't kind of been intentional about the way they've structured their business. And they like to punish a sole proprietor, someone who's receiving the 1099 in their own name, by making them pay an extra 15.3% in what they call self-employment taxes on top of their normal income taxes. And as a self-employed realtor in terms of business structure, this is probably your biggest problem if you're in this structure, okay? And so let's kind of put some numbers to that. If you were a realtor who made $140,000 after all your expenses, right? After all your write-offs, this is the number that we're gonna pay taxes on. If you're in this structure, you are going to be paying an extra $21,000 in self-employment taxes, right? That's 15.3% of $140,000 on top of what your normal ordinary taxes are, which is, probably somewhere in the range of $30,000 to $50,000. So not only are you getting hit with your normal taxes, but now the IRS is punishing you because you haven't taken the time to properly structure yourself as an actual business with an extra 15.3% tax on top of that. And so when people come to me and they're at this level and they haven't structured, it's not uncommon for me to see realtors making $140,000 net paying somewhere in the range of a 40% tax. And now that's just absolutely ridiculous, right? You look at the news, you see these billionaires paying 0% in tax, and yet here's someone who's making $140,000 paying 40%. So that is just something that we absolutely want to address and we want to fix, because I just hate, it really burdens me when I hear someone say, oh, I look at someone's tax return, I hear them that they're in this structure, and I see they've been in this structure for a few years and they've had really good numbers, and to see that they've been paying 40% in taxes just because they didn't know how to structure their business, it really hurts me. And so hopefully from today, we can shift out of that and get you into a place where you're saving much more on taxes. So the next step that I usually see realtors take from there, from the sole proprietor, where you're receiving the 1099 in your own personal name, is most realtors will go and they'll open up an LLC. And this is where they stop, right? Because the information isn't out there to let you know you need to do more. And so the reason why only having an LLC without doing anything further, right? There's an election that you have to file that I'll talk about that in a bit more depth a little bit later. But the reason that it's an issue that you stop there is because the IRS looks at you having an LLC, just having an LLC, and not telling them that you want to be treated differently by filing that election. If you just have an LLC and you've never filed an election or anything on that behalf, then what they're going to do is they're basically going to say, okay, you own this LLC, great. We don't care. We're going to treat it just as if you were receiving this income in your own personal name, and we are still going to charge you 15.3%, that extra 15.3% tax we talked about. The IRS wants to charge you that extra 15.3% on all of your income, whether you have that LLC or not, right? And so I think there's a common misconception out there where, people know about this 15.3% tax. So they go and they hear they should open up an LLC, and they do, but that's where they stop, thinking that, okay, my LLC is receiving all the income. I'm running all my business expenses through my LLC's business bank account. That should help me save on taxes, right? And the problem is, if you don't take it a few steps further, then it doesn't. The IRS looks at it and says, oh, you're an LLC with only one owner. It's disregarded for tax purposes, and congratulations, we're going to tax you an extra 15.3% on all of your income. And so really the issue becomes, right, just a lack of knowledge. Because if you've gotten to the point where you have an LLC open and you have your LLC kind of receiving all the income, you're running your expenses through the LLC, then you are perfectly set up for this election that we're going to talk about now, where essentially you're going to get the most tax savings. So you're right there. There's just a few extra steps that we have to take to make sure you're getting that 5-figure tax savings. So, right, I've teased it enough. What is this election that I'm talking about? Well, this is called a Subchapter S election. And essentially what you're doing is you're telling the IRS that you want your LLC or your PA, I didn't talk about that because it's not as common as the LLC, but you want your LLC or your PA to be taxed as what's called an S corporation. So now, why this is so significant is that when we tell the IRS that we want to be taxed as an S corporation, it allows us to split the income that we make into two types. The first type is the money you make as an employee of your business, And the second is the money you make as the owner of your business. So when we split the income, right, only the employee portion of the income is getting that extra 15.3% tax. So we are going to essentially save 15.3% in taxes on the entire owner's distribution part, right? And so that's a lot. So let's think about this example, getting back to that $140,000 net salary. Okay. So if you've made that same $140,000 we talked about before after all your expenses, we could split that $140,000 into a $50,000 salary to you and a $90,000 owner distribution back into your pocket, right? And so the significance of that is that you end up saving that 15.3% on the $90,000 portion, which is a tax savings of $13,770 just by being in the right structure, right? So the beauty of this is as you continue to make more, right? Let's say instead of 140, we made 300. That spread continues to grow and grow and grow because the amount of your owner distribution continues to get larger and you're saving a percentage of that owner's distribution as you go along. So I hope that made sense. Like I said, the key thing about that S Corp is to be able to split your income into two segments. The first is you paying yourself as an employee that you pay the 15.3% on. And the second is you taking payments as an owner's distribution that you save the 15.3% on. So just by switching tax structures, right, in that $140,000 example, nothing else different. You simply filed an election with the IRS and you did some extra steps to make sure you were compliant. You save 5 figures in taxes, right? And that gets even bigger as you make more money. So a common question I get when people hear the S Corp, and especially if they haven't consulted with a CPA, is getting back to the idea of the LLC. They'll ask, okay, I have an LLC, I haven't made this election, but I heard if I had a partner, right? So if there's 2 owners to the LLC, then there's all this different types of tax rules and the IRS no longer disregards the LLC. And while the answer to that question is yes, it changes the way that the return gets filed by having 2 members of an LLC. But ultimately, you get no tax advantages in a real estate sales business. And the reason for that is that if you are actively working in your business, the IRS kind of knows that there's a little loophole there that people can just add a business partner and try to get away from that 15.3%. And so if you are actively working in that business, even if you have 2 members of your LLC, they're still going to tack on that 15.3% in taxes. And now you've just created a headache for yourself in terms of potentially bringing on a business partner you didn't want, or even just the headache of paying an extra 15.3%. So yeah, it's not to have 2 members of an LLC without turning it into an S corporation does not give you the same advantages. And I have a story on this of a client that I consulted with. It was probably about 3 years ago at this point. And they were a really up and coming realtor. It was kind of their first year starting to make some money, and they couldn't get a CPA to talk to them. They were too small for the CPA to pay attention to them. And so they knew about this LLC rule. They knew that, if they just had themselves on an LLC, it's basically for tax purposes as if the business didn't exist and they were going to have to pay a lot more in taxes. And so what they did is they added a relative as a 1% owner to their LLC, thinking that that was the way that they could end up saving, taxes in the way an S corp can. And the ultimate reality is no, it doesn't work that way. You can't add someone onto your LLC as a 1% owner thinking that it's going to give you this S corp tax advantages because the IRS knows that it's just a loophole and you're kind of just doing things on paper to save on taxes. And they don't like that very much. So all that to say is that the S corp really is the option that 99% of realtors want to do. So now, right, you hear all that. what do you need to do to make an S Corp happen? What do you need to do to save that 15.3% in taxes on a big chunk of your income? Well, first and foremost, you need to have either an LLC or a PA registered within your state, right? So we need to get to the point where we are no longer getting paid in our own personal name, but we need to have either an LLC or a PA established and start getting paid through there. That way we can tell the IRS, all right, we're serious about business now. We are filing an election to start being treated like a serious business, and therefore we deserve the tax savings of a serious business. Now, the next question that I get a lot is, okay, this sounds really great, but how much money do I need to be making before this makes sense? And, it's quite variable, right? Working in S Corp is more of an art than a science. And what I typically tell people is that you really need to be making at least $60,000 a year, but more so leaning towards a rule is between $60,000 and $100,000 a year is when you need to start thinking about this, right? And so the reason why it doesn't make sense to do this until you hit at least $60,000 to $100,000 in income is when we go back and think about how the S Corp has to operate, you have to pay yourself a portion that is a reasonable wage and a portion that is an owner's distribution. Now, that reasonable wage portion, that number, there's no hard and fast rule about what that number should be. It's an art. They don't give you any formula. They don't give you any minimums. They don't give you any maximums. But the general rule of thumb is, right, can I have support that if I hired someone to do this, or if someone was looking from the outside in, that this is a reasonable wage that I believe that they received? And so this is part of the art, right, that when you're working with a CPA or you're working with a consultant, you'll help determine it based upon what your individual circumstance is. But getting back into the main point, if you're not making at least $60,000 to $100,000 a year, you are going to probably have to pay yourself your full amount of earnings as a reasonable wage anyways, right? You're probably going to end up paying yourself somewhere in the $40,000 to $60,000 range as a reasonable wage. And so if you're going to pay it all as a reasonable wage anyways, and you're going to pay, that 15.3% on that portion anyways, it doesn't make sense to go through the hassle and the headache of turning into an S Corp because you're not going to get any savings from it. So it's just going to create much more of an administrative burden, and it's just going to cost you more in the long run by doing it too early. Now, with that being said, if you made, less than $60K this year because you started in October, but you're planning on having a huge year the upcoming year, then let's get that proactively set up for you and make sure that you're saving that 15.3%. So, the two things that we talked about already, you need to have the LLC established, you need to have the LLC or the PA established to lay down the foundation for this S Corp. You need to be making at least $60,000 a year in net profits. You need to file an election to the IRS and sometimes your state, depending on what state you're in, letting them know that you want to be taxed as an official business, as an S corporation, okay? And so this is an election that is an actual form that gets filled out and you mail it into the IRS. So if you're unsure whether or not you've made this election, if you haven't signed an actual paper form and sent it into the IRS or had your CPA send it into the IRS, the odds are that you haven't done it, right? It's not a button you click when you're creating your LLC or your PA. It's an actual form that has to be mailed in. So you've got to get that election in, and then you have to have payroll set up to be able to pay yourself that reasonable wage we keep talking about, right? The portion of your income that you're going to run it through payroll, and you're going to end up giving yourself a W-2 for a portion of your income. And now this last requirement, I always like to have my S Corps do, and I really do think that it is a requirement, and that is to keep your books on a quarterly basis, at least on a quarterly basis. And the reason for that is once you file this election to save, your 5 figures in taxes, you are telling the IRS that I am a legitimate business owner. I want to be taxed as a legitimate business owner because I'm not just someone getting paid on a 1099 and taking write-offs. I'm a business owner and I deserve the deductions that business owners get. So, on the flip side of that, right, we are now telling the IRS that we are a real business, and when we do things, we have to structure it the way that a real business would do it. And so, there are some deductions out there, and there's a lot of planning out there where we need to make sure that we're very intentional with what we're doing in this model. And the way that we can do that is by keeping our books on a quarterly basis, making sure that we're structuring everything in a way in which you're getting the maximum amount of deductions. So need to make this S corporation happen, you need to have an LLC or a PA established. You need to be making at least $60,000 a year. You need to file an election with the IRS, letting them know you want to be taxed as a real business, an S corporation. You need to have payroll so you can pay yourself. And you need to be keeping your books on at least a quarterly basis. And so at this point, you might be thinking to yourself, wow, I know I need to be an S corp. I know I want to do all those things. I had the LLC or the PA set up and I was getting paid, but I didn't know about this election. I didn't know about this payroll. And I'm really sad that I can't do this for my 2022 taxes because I had a great year. I guess I'll just do this for 2023. And the good news is, right, is that we're not at the end of the year yet. So if you've already had your LLC or your PA established, what you can do is you can get your election retroactively applied to the beginning of the year. And you can, say the reasons as to why you didn't do it, which a CPA can help you get that accepted. It's no problem. But there's still time, as long as we get that election in before the end of the year, then there's still time to go back and save this extra 15.3% on a large majority of your income before year end. It's awesome. We can go back and say, oops, sorry, I forgot to file this late. Please treat all this income as S corporation income. I'm now a real business. So qualified me for this 15.3% in savings. And so there's still time. You need to act before the new year, because if you wait until the new year, if you wait until January 1st to get this implemented, and really you need to have it implemented before there so the applications and things can get processed. But if you wait until the new year, it's too late and we can't go back and change it. And the reason for that is that this payroll portion of the S corporation is huge. If you do not issue yourself a W-2 when running this structure, then what the IRS can do is they can go back and they can say, all right, any amount of money that you've taken from the business that you didn't give yourself a W-2 for, we're now going to charge that extra 15.3% tax on all of it. And not only that, we're going to charge you with penalties and interest on top of it. So we can't miss that payroll factor, which has to be ran during the year. So if you have an LLC or a PA already established, you haven't filed this election yet, but you want to because you want the maximum tax savings, you want that 5-figure tax savings, then you're going to need to act before year end really pretty quickly now, because there's going to be some time in between, and you can still get that 5-figure tax savings for your 2022 taxes. So in conclusion, right, I talked about a lot of things here, okay? And I know that I just speak it like a second language, but it does not come across as a second language. It may be worth watching this 2, 3, maybe even 10 times to kind of let it truly sink in with what I'm saying. But if that's not something you want to do, if implementing this yourself is not something you want to do, and it's not something you want to worry about, I specialize and I work with realtors and brokers pretty much only exclusively. And I have created my business to be a one-stop shop to make sure that you have all the requirements of this S corporation in order and running in the background, so you can focus on what you do best. You can go out and close sales and know that all these requirements are being taken care of behind the scenes without you having to worry about it. So if you're interested in having me help you to set up this S Corp structure, or to maintain this S Corp structure for you to save 5 figures or more in taxes just by switching your structure, or you want me to take a look at your specific situation and see what structure might be best for your specific situation, there is a link in the description to download my free ebook. And when you download that ebook, you'll be directed to a calendar page where you can book a free 45-minute tax and accounting analysis where we'll sit down, we'll talk about your business, and I'll let you know the opportunities that are out there and the tax savings that I can get applied for you and your business. So act quick. Don't miss out on the opportunity to save 5 figures or more on taxes in your business before year end. Don't come to me in January and say, oops, sorry, I forgot. Is there anything we can do? Because there's not. And it's going to really pain me to know that the opportunity was there and we didn't take it. So act quick. If you have any questions, like I said, download the book, schedule a call, and I'd love to get together and see what I can do for you. Until next time.